Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Investing successfully requires looking ahead, especially in fast-moving sectors like food and beverage. Consumer tastes are shifting quickly, moving away from old standards toward healthier, more sustainable choices. This change makes the food industry particularly volatile. While some food sectors offer incredible growth potential, others carry major risks. This video focuses on identifying processed meat brands that present significant investment dangers. These risks stem from stagnant growth, growing health awareness, and potential regulatory changes. If you are serious about protecting and growing your hard-earned money, understanding these red flags is essential before you commit any capital. Spotting the financial warning signs: low growth and high debt risk. Processed meat refers broadly to meat preserved by curing, salting, smoking, or adding chemical preservatives. Think sausage, bacon, hot dogs, and deli slices. Historically, these companies were reliable investments, but the landscape is changing. Today, many traditional processed meat brands show clear financial warning signs that sophisticated investors cannot ignore. We'll look at the tangible numbers and business failures that should give any potential investor serious concern. Failing to evolve. Companies stuck in an older business model. The biggest red flag for any food industry investor is a lack of innovation. Processed meat companies that haven't dramatically invested in non-traditional product lines are struggling. We're talking about failure to launch successful organic options, low-sodium versions, or plant-based alternatives. A brand entirely reliant on their grandparents' sausage recipe is fundamentally unprepared for the modern market. Their sales often remain flat or even shrink. This stagnation signals a fundamental poor future outlook for investors. Investment capital naturally flows to companies that demonstrate forward-thinking management and product development, not those clinging to outdated, highly processed offerings. When a company stops innovating, its stock becomes a holding pattern at best, and a liability at worst. Rising costs and narrowing profits. The squeeze on meat processors. High inflation has put significant pressure on the entire food supply chain, and meat processors are feeling the squeeze especially hard. Costs for essential inputs like cattle feed, energy to run cold storage, and employee labor have skyrocketed. For companies that already operate with thin profit margins, these rising expenses are brutal. Imagine a company whose gross profit margins are only 5%. When energy costs increase by 15%, that tiny margin quickly vanishes. These businesses struggle to maintain consistent earnings, and poor earnings directly hurt stock value. Economic forecasts suggest that costs will remain high. This guarantees that processed meat brands with historical operating inefficiencies will continue to face serious financial turbulence, making their stock a high-risk bet. Health and regulatory headaches that tank stock prices. Beyond internal financial troubles, processed meat companies face mounting external pressures driven by public health concerns and government oversight. These pressures often translate into massive unexpected costs and sudden stock price drops. Simple language helps us understand these complicated forces at play. The nitrite dilemma. Brands facing expensive recipe changes. Governments and influential health organizations worldwide are increasingly targeting chemical preservatives like nitrites and nitrates, which are common in processed meats for flavor and preservation. There is mounting evidence linking these additives to various health risks. This focus means brands heavily reliant on older, cheaper preservation methods face huge problems. If regulations mandate the removal or severe reduction of these chemicals, companies must spend fortunes on reformulation. Reformulation is expensive and time-consuming. It requires new testing, new ingredients, and often new equipment. Brands that resist this change or delay the process will carry greater regulatory risk, directly harming their financial stability and future investment viability. Understanding these risks helps you make smarter, more informed investment decisions. Stay tuned for Part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.